Welcome to the daily update, where I'll go over the action in the market for Thursday, June 26th, and we'll see how things look for Friday, June 27th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. All right, didn't quite get there, less than a point, but we didn't set a new intraday all-time high. We're close, and the futures were positive that I checked right before I started recording this, but it's many hours before the open. And we could theoretically set some kind of a new all-time high in Friday's session. The one big change that we're finally starting to see is a trend is now developing, and it's a positive trend. So we're positive on all time frames. We're showing good short-term momentum. We're getting close to a new all-time high. So things are looking pretty good. We've gone on this, my goodness, what would it be, a 43% round trip. When we went down starting in March, we hit the bottom in April. That was about intraday, about 21% or so down, not long after setting the all-time high back in February. And now we've come all the way back up. And we are potentially coming into a positive seasonal time. During a post-election year, the last day or two of June tend to be positive. Doesn't mean we'll go up, but they have tended to go up before. And then the first part of July tends to be positive for the NASDAQ, which could also mean the NASDAQ 100, which could then spill over into the S&P 500. Now, nothing is ever for sure. There are geopolitical things that could come into the mix at any time. They're still there. It just seems like we're not hearing about it quite as much. Things are still going on, but it's not at the forefront of the news right now. And of course, there's always something to worry about, but you got to hand it to the market. It was down pretty solid. We were right on the verge of entering a bear market back in April, and it's been choppy. And we go up for a while and then just kind of drift sideways with a positive bias. And now we're establishing things right now anyway that are looking a bit more positive, but it's not blanket positive. That's when I get concerned, is when pretty much is when everything is firing green. That's about when we've topped out, and it's more gray with a leaning to the green side when we look a little more positive. All right, so right at the open, we had a higher open. Now, the pivot points were not really wide in Thursday's session because we had a fairly narrow range on Wednesday, and those are calculated from the day before. But we opened above R1 at 6107, so we're still above 6100. That earlier in the week was at that level, 6100, was acting as overhead resistance. Well, we gapped above it on Wednesday, and then we were able to stay above it on Thursday. Really very little selling that we're seeing over the last few days. Volume is below average, and that's always a concern. That's a technical analysis negative divergence when you're going up and setting an all-time high on a decrease in volume. Okay, so we'll just keep that in the back of our mind there. And then we got above R2, and I forgot to put the actual numbers in here. And then we just kept drifting higher from R2. We didn't really see any selling coming in later on. We held the gains, but we did not set a new all-time high. We were just a little bit below that 6150 level. We were up 0.8%, below average with volume, as I already talked about. Positive across all time frames right now on a trending basis and starting to develop a trend. But we could have a down day or two. And then Monday is going to be kind of crazy because it's the last day of the month and the last day of the quarter. And that can produce some window dressing and adjustments and kind of make it a really strange day in that aspect. So nothing is ever for sure, but we are looking at the weight of the evidence here, or what I call the consensus approach, and we are looking positive. We were looking positive, we just were not trending. Now it looks like we're starting to develop a trend. And nothing major geopolitical, even though you've got Iran, Israel, you've got Daddy at the NATO summit, and of course there's already a song that's come out and a video that was put out by the White House. That's kind of interesting. And so, I mean, there's heavy duty things that are being dealt with here, but the market is leaning more positive. In fact, the market has this real ability to rationalize things either positive or negative. And when it comes to the GDP that we received on Thursday, yeah, they put growth down and inflation up, but the market said, well, that's just old news anyway. Where it could have just freaked out over that and used it as justification to go down. All right, so some comments. The mega caps and semis, they're doing good. This is what's leading things higher, and that's what really helps the S&P 500 to go up is when the mega caps do well. Tech does well when that's the big growth area. And when semis even do better than tech, that's even more positive. And we're starting to see some golden crosses here. Not quite with the S&P, but we are seeing it a little bit better. Now, in Thursday's session anyway, small and mid caps were strong. Now, but they have these little periods where they're strong and then chop, 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 give all those gains back. But we're seeing some improvement, but we need to see more follow through with the small and mid caps. Then the NASDAQ 100, which set a new all-time high on Wednesday, it set another new all-time high on Thursday. The S&P was less than 1 point away. The previous all-time high was at 6147.43. That's what we hit back on February 19th. And we got close, less than a point away on an intraday basis, but not quite yet. Now, here's our short-term list, and there's a couple of ways to look at this. When the short-term indicators are looking extreme positive, when I say OB, that's overbought or extreme positive, that we get a little bit concerned. But when the bigger picture is positive and we're not quite back to an upward trend yet, we still have the 50-day moving average below the 200, but we've been above both of those moving averages for quite some time. And every day that goes by, we're getting close to a golden cross with the S&P, but the backdrops has remained fairly positive. So we don't necessarily freak out when we start to see a really long list in the short term. We can say, okay, we're aware of that, and we are looking a little bit toppy, and we are coming back to the previous all-time high, which may act as resistance in and of itself, a rejection, at least at this point. But then we can turn that around and say, okay, this is showing across multiple different charts with the consensus approach that the short-term trend is looking good. And the short-term indicators that are on this list are quite positive now. A new addition to the list is the Stochc RSI. The Williams percent R has been there for a few days. CCI 14 and 20. The stochastics improving there. And I'll show you all these charts. The slope oscillator trying to get back above its moving average, but we are far away from the 20-period moving average, but we've been far above it here now for a few days. And then the short-term RSI is looking a little extreme that way. Intermediate term, we're getting up into the +3 channel with the standard deviations chart. That's we can stay up there. Doesn't mean we have to turn and go the other way. We just want to make note of that, realizing that the market could be getting a little bit overextended. Now, during this whole time that we've been going through this trendless environment, the intermediate term trend has really held up quite well. It was the short-term trend that was getting kind of choppy, and we'd have an up day, then a down day, then a couple of up days, and flat days, and that was confusing our trend indicators, saying, okay, I give up. There is no trend here. And then the CMB composite, which is not on this list very often, that's looking extreme. And then the rate of change going back 50 periods, that's been on the list for a while because we're still going back 50 periods is early April, and those were much lower levels. And so that's why we're seeing such a high reading there. The PMO is improving, and our momentum oscillators are improving as well. The long-term ones, they're long-term, so they take longer to turn up. They're still negative, but the short and intermediate term momentum oscillators are improving. The Sean trend meter is also on the list. Now we're back above the upper Bollinger Band, and that's what the percent B indicator measures. We typically don't see this very often, and when we do, it tends to not last for a very long, and we need to see either price come down or the Bollinger Band go up. And I was pointing out last week, because we weren't trending, we were just chopping along mostly sideways. The Bollinger Bands were coming pretty close to each other, and a lot of times that happens before we see a move. Now, we don't know if that's going to be an up move or a down move, but that is likely what's starting to happen now. And at least at this point, it looks like it's a move to the upside. We're also far away from the 50-period moving average, and then the bullish percent. It didn't change, but we're still at 70. That's when the NASDAQ 100 bullish percent index is considered to be extreme positive. No change with the overall scenario. The Fed is still thinking, oh, we might come up with some rate cuts at the end of July. A couple of the Fed officials came out this week and said that. We didn't hear it from Jerome Powell. So we're going to be having another meeting here coming up in July. The dollar continues to go down. And again, that's helping stocks. Now, it sucks if you live in another country and you have to use the exchange rate. You can see a pretty big change. But if you're in the US, at least from a stock market perspective, that tends to be more positive. And there's some rumors out there that this is being manipulated, that the dollar is purposely being pushed down to help the stock market hang in there. Now, it's just a rumor. You can take that just as information and just be aware of that it could be happening, but it may just be the dollar seeing some weakness. And interest rates are down, and that's helping stocks too. We're at the 4.25% level now with the 10-year yield, where after Wednesday we were at 4.29%. Sentiment is positive, so people are feeling better, but without feeling really, really good about things. We're coming in at 62, where we had been at 59, and this is kind of the big change. We're positive with the trend, and we're now trending. The ADX is turning back up and crossing above its moving average. It's still below 20. Now, 20 is a static number, and I like to use charts that are more dynamic. And I kind of have some issues with the PE ratios because we use a 10, 15, 20 scale, and that never changes. We tend to use static numbers with the VIX, and that sometimes can change over a period of time. But the way I use this is that we're turning above the moving average. That shows a strengthening trend, but we are confirmed with that trend when the ADX actually comes back above 20. And the bias is positive, and I've changed the momentum over to positive because we're now starting to see a bit of a trend. Okay, so the economic reports had a pretty long list here. And this was actually a surprise to the upside. We've been seeing a lot of weaker than expected economic reports over the last couple of weeks, kind of concerning the market that maybe the economy is having some problems. And if the Fed comes in and cuts rates, it may be for that reason, to try to stimulate the economy rather than just fine-tuning it. But durable goods really shot up, 16.4% month over month. They expected it to be up, but only up 6.6%. Last time it was down 6.6%. If you take out transportation, not as robust, but still greater than expected, up 0.5%. They thought it was going to be up 0.1%. Last time we had the report, it was unchanged. Then initial jobless claims went down. That's showing that the employment situation is holding up, at least in the short term, because we're down below the 247,000 they thought were going to come out, and down from the 246,000 that we saw last week. This number came in at 236,000. But this is still a little bit of a concern, though, the continuing claims. So companies are more reluctant to let people go initially, but those people that do lose their job, they're having a more difficult time finding another job, and it ticked up just a little bit, not much. Where we get more concerned is when this number goes up above 2 million, and we're kind of getting there. It's 1.974 million. Last time it was at 1.973 million in the previous week. Then this is what could have just freaked out the market, but they said, old news. Now, it was not always that way. Back in 2005, 2006, actually you can go back into 2004, that we were going through some difficult times. We were coming up out of the lows after the dot-com bust, and then 9/11 happened, and just really difficult times. Well, they came out with GDP and then they said, oh, yeah, not only is GDP negative, but we're going back the last 3, 4, 5 reports and revising those numbers down too. And the market freaked out over that. They didn't say that was old news. They're just like, okay, we've been in a recession longer than we thought we were. Let's freak out some more. So it just depends on what the current mood is of the market. But GDP, the last time we had this report, it was down 0.2%. That was, excuse me, that was the second estimate. Then they came out with the third estimate. Now it's down 0.5%. Now, probably one of the things that's encouraging is so far the forecast for second quarter GDP, because what we're talking about here is first quarter GDP. We're getting positive numbers for second quarter GDP. And you have to be in negative territory with the GDP for 2 quarters for that to be, usually that's the blanket, the definition of a recession. But there's other things that come into that mix as well. And so we're still getting positive numbers, at least for the second projection, second quarter projections. So maybe that's why the market was able to throw this off a little bit more. And then last time it was down 0.2%. So the growth part went down for GDP. The deflator part, this is the inflation component, it went up. And not much, but still it went up. It did come in previously at 3.7%, which is what they expected. Now it came in at 3.8%. So this is kind of the worst of both things. Growth down, inflation up, but the market just went, we don't care, at least today. So, all right, then these are just numbers I'm going to read. I do have charts of these to show you. The advanced international trade in goods deficit, greater than expected, minus, or greater than the previous reading, I should say, minus 96.6 billion. Last time it was just a mere $87 billion deficit there. Retail inventories were up 0.3%. Last time they were unchanged. Wholesale inventories down 3%. Last time they were up 0.1%. And I just read off the numbers here. Then I don't have a chart of pending home sales either. They were up 1.8%, which is like, okay, real estate's been having some trouble here. And you've got, okay, some potential things changing in New York, and you've got a lot of people that own buildings there that are like, okay, if this person wins the mayoral race, that could just decimate the buildings that we own, and okay, what's that going to do? But that set aside here, the pending home sales were up 1.8%. They did expect them to be up 0.4%. Last time they were down 6.3%. All right, so here's some charts. Weekly claims coming down and the moving average is coming down. That's positive. That means that on a short-term basis, the employment situation is holding up. Where we're getting a little concerned, though, is the continuing claims. They continue to go up. Not over 2 million yet, but they are going up and the moving average is going up. So we look at them together with the unemployment rate, or the red line, those are the initial claims going down, continuing claims going up, bit of a negative divergence there. And then the latest reading on unemployment was unchanged at 4.2%. And then looking at durable goods, really shot up. And we looked at it on a month-over-month basis. This is year over year here. And then if you take out aircraft, it's still coming up after it had been chopping more or less sideways. And then month over month, pow, really, really high reading. And the market took that as pretty good news. Then we switch over to the GDP, where we're seeing GDP, the blue line, going down, and the deflator, that's the inflation part, the yellow line, that's going up. You don't want to see that happening. You want it to be the opposite, if anything, but the market is not paying attention to that. Personal consumption dropping off just a little bit, so I guess folks aren't taking in quite as much now. Net exports are still getting more negative here. And then real GDP on a year-over-year basis, still positive. We're above the zero level here, even though we are coming down. All right, then looking at some Isabel Net blog charts. Surges in energy prices suggest high probability of recession. That's not what we're seeing. It lasted for a couple of days. Now, oil is still up in about the mid-60s. It did climb. It's been climbing over the last few days. But you can see other times when events have happened, because, 1973, the oil embargo, the Iranian Revolution, 1979, and all the other things that happened. We saw this turn black. And even Russia, Ukraine, that really made oil prices spike up, but then they came back down. Not really seeing that here this time. So it doesn't seem to have the impact it has had before. All right, then concentration of the S&P 500 market cap and earnings and the 10 largest index constituents. Those are the stocks that make this up. So you have the market cap, 38% of the 10 largest companies. We have the Magnificent Seven, the Great Eight, the Illustrious 11. This is 10 for some reason here. And that's showing most of the market cap for the S&P. That's why I show charts of a few of these, not all 10, but I show 7 or 8 different charts. And the earnings are up as well. And that's what drives these stocks to be higher. Even though they're expensive on a PE ratio basis, even when you look forward, well, their earnings are going up. They're not as robust as they were before, but they're still continuing to go up. And growth sectors are outperforming in the US. Now, this is interesting. The dark blue line, this is the, okay, they kept it the same way here. The dark blue line is value to growth. And we're seeing that on a global basis, the ratio is going up. But on a US basis, the ratio is going down. That means growth is outperforming value. And I hit that really hard over the weekends with the intermarket analysis video. And this is the opposite. Well, now we're seeing the US market starting to pick up a little bit of steam if it can hold on to that. And we might see a general shift in this overall ratio because the rest of the world was more focusing on value. And that's why they were outperforming because growth was struggling. Didn't really go negative, but it was struggling, not showing the leadership role that it was before. And over the last few weeks, we've been seeing a subtle shift back over where growth is now starting to lead. That's why we have the NASDAQ 100 setting new all-time highs 2 days in a row now, and the S&P not far away because a big part of the S&P 500 is also growth. All right, market implied U.S. recession probability. Okay, all over the place where we have an average of 4%. The forward-looking Fed funds rate, that's the one that's kind of suggesting that we might go into a recession the most. And there's a number of different ways that you can measure this, and we're not seeing anything that's all that scary, at least at this time. And the market itself, we can look at the market and just tell they're not really thinking we're going to go into a recession. But we watch these charts every day, and I do daily videos, I do weekly videos where we really keep up on these things. And looking stretch, the S&P's at 22. See, this is what I'm talking about with expensive. These are forward earnings. It's more than 35% above its 20-year mean. The mean would be a little bit over 16, and we're up at over 22, probably even a little higher now. But I talk about this in every intermarket analysis video over the last few years, and we've been overvalued. You can see we've been way above this line for quite some time. Even with the March and April drawdown that we saw, we never did get back to this yellow dashed line before we started going back up again. All right, the US dollar is sinking even as treasury yields rise. Usually these are pretty coupled with each other. We've been seeing a real disconnect, which is leading some to believe that maybe there's some currency manipulation going on now, which is helping. It sucks because you're losing 10, 15, 20% of the value of your dollar, but it helps the markets look a little bit better because when you do conversions, now you get more dollars because the other currencies in other countries are worth more, so the exchange rate is more favorable to you. It just sucks if you're traveling or if you're living in another country. All right, then hyperscales spent a collective. This is just showing that they're the big companies out there like Amazon, Microsoft, Google, whatever this is, and all of them together. I don't know some of the company symbols here, but if they thought that the economy was really going to fall apart, they would not be spending money to build new products and a lot of money going into AI and so forth. And we're just seeing this explosive growth. It's called CapEx, capital expenditures. They're using their own money to invest in new technologies and to grow, and that is a sign of health. And I have to learn what those symbols are. All right, then the risk-adjusted return has been lackluster. Basically, the idea is that if you own stocks, you should be compensated more because stocks are risky. They go up, they go down more than bonds do. If you buy a 10-year bond or a 30-year bond, you've locked in that interest rate. Now, you might have the risk that interest rates may go up and you're stuck with a lower interest rate, but you're assured to get your money back at the when the bond matures and you know what that interest rate is going to be. Where with stocks, it's like, okay, we're going up, we're going down. And so you should be compensated more for owning that stock, but it's been pretty anemic so far in 2025. Then here, the risk adjusted returns, also pretty anemic. It's been disappointing so far, reflecting a challenging market environment characterized by increased volatility. And volatility from stock market perspective, that means down. We're going up, but you don't really use the word volatility when we're going to the upside. It's usually only the downside. All right, then the fair value model, and I don't know what goes into this model. It's something proprietary, but this actually suggests that the 10-year yield should be coming down here as far as the overall yield, and it has been. We're down at about 4.25. When they did this, we were just a little bit under 4.5%. And according to this light blue model here, interest rates should be a little bit lower than where they're at. And so far, that seems to be happening. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, so not an awful lot. We didn't necessarily see the smart money coming in and doing everything. Maybe they're going to let, the amateurs and the hedge funds push us up to a new all-time high before they start going in and doing something. Or maybe they're going to take the summer off and just kind of get away for a while. But we did gap above R1 here. R2, which I didn't put on the sheet, it was at 61.22. R3 was a little bit above 61.50. We never got up there, but you can see we just kind of drifted up and up and up. Not any significant selling along the way, and closing pretty much at the intraday high. And we're up a little bit in the initial overnight session. We went up, and then we've been pulling back here. But the futures were solid before Thursday's session, and we just kind of chopped along sideways and then took the market higher. And this is what we've been seeing. When we have the big up days, it tends to happen while the stock market is open. When we have those gap lowers, like when DeepSeek came out and geopolitical things and trade wars and tariffs, that's been coming out over the weekend. And the only thing really reacting to that, even though they're closed on Saturday until Sunday evening, when we see gap lowers, that's generally been driven by the futures contract. We have a gap from one day to the next. Where when we've been coming up, we're seeing most of the strength during the day itself. And I take that more as positive. Okay, and kind of neck and neck here, but both the intraday growth and value charts are going up. And we're improving here. We were kind of range bound going sideways, but this didn't fall apart as we were going through June and we were not trending. Now we're starting to see some strength here on an intraday basis as growth is outperforming value. Then end of day, growth was up more than value, up more for the mid caps, and they were about even, but growth was up a little bit less for the small caps, even though small caps had a pretty good day. So we came down a little bit with the end of day small cap growth to value ratio, but it's still looking very healthy. Mid cap growth to value, doing pretty good there. And the index, see, we're just right back. Are we finally going to be able to break out? Let's go back to the small caps. See, we still haven't surpassed this previous high that we set back in early June. And that's kind of been what's happening here. We just kind of come up, then we come back, then we come up, then we come back. And that's been happening for the last few years. So that's why I keep an eye on the small and mid caps, because they're riskier stocks. And some folks really prefer to get into the smaller companies. They're trying to find the next Microsoft or the next NVIDIA. But I look at this as a way of just saying, what's the overall climate like? We still have the large caps pretty much outperforming. Okay, then we are improving here, not at a high yet with this ratio, but when we look at the S&P growth to value ratio, it is continuing to improve after recently setting a golden cross with the ratio. The growth to value ETF ratio here, improving. And we're improving. We're still above the 200-day moving average with discretionary to staples. This has been a lagging area, but we're holding up so far with this. And large cap growth, we're above all the moving averages. The moving averages are starting to turn up, and that is also improving. And this is going down, which is positive when it's value to tech, and which is a big growth area. When this ratio goes down, that means tech is outperforming value, and that's what we see in a more positive environment. So here in the short term, we're crossing above the moving average, but we're still below 20. We're positive because the green line is above the red line. This is the one that I focus on the most. We're finally above the moving average. We're positive with the green line above the red line, but it's not confirmed until the ADX actually goes above 20. Now, confirmed, not confirmed, that's not as imperative to me. What I do is, and I put the moving average on this. I actually added this to the chart, and I use it for some context and to show the general movement and then strength. To me, the most important thing is that right now, anyway, now we could start coming down from here and this could all go back into non-trending mode. But when it crosses above the moving average, to me, that's the most important thing. And it's just kind of like dessert or something here when we actually cross above 20, because we want the trend to actually be getting stronger if we're trying to ride some kind of a trend. All right, and we're below average with volume with the oscillator, and for the second day now we are, it's really hard to see, but we're a little bit red there with the histogram, and that's a concern to be near all-time highs and to be going up on a decrease in volume. Okay, that's some people don't think that's that big of a deal. I don't know. Sometimes it is, sometimes it isn't. I just want to be aware of it nonetheless. Okay, sentiment, VIX under 20 and declining, and that's positive. The VVIX, or the volatility of the VIX, is also declining below its moving averages. We're starting to roll over with the momentum, but the MACD hasn't quite crossed below its moving average, so the VIX is going down, but the momentum hasn't shifted yet to down anyway. And we're no longer extreme with the skew index, because we're also, dealing with all these call options that I talked about in yesterday's video coming down out of the red area. So as long as we stay down out of the red area, I'll stop showing this chart. And this just means when we're up in the red area, we spike and then come down. That usually anticipates some kind of a big move. We don't know if it's an upward move or a downward move. That's why I have these lines on here, because sometimes it was a top, sometimes a bottom, sometimes a continuation. But looking at some of the call option data, which benefits if the market goes up, it could have been excessive calls that were being purchased. Okay, tick down a little bit with this fear gauge and tick down not very much, but we did tick down with this other fear gauge. We did get the weekly reading from individual investors. They're still slightly negative, although improving a little bit from the previous reading. This is where we're showing some more strength here. We're actually setting a high with the risk on to risk off ratio. These are high beta stocks: Apple, Amazon, Netflix, Google, all that. When folks are getting into those versus the equal weight, which are more conservative stocks, that means that the market is more positive and more in risk on mode at that point. We're also really going up here with the high beta. Again, the big Microsoft, Google, Nvidia. When this ratio is going up, which it has been doing since it bottomed back in April, that is more positive for the market as well. Pretty much not really that big of a change with the equity put call ratio daily chart. And we're really dropping off here back down below the red line. And when this is going down, that tends to be more positive. When we go below the red line, that's where we start to get extreme. But we can stay here for extended periods. Also going down just slightly, but not moving all that much with the 10-day moving average of the equity put call ratio. We're actually going up a little bit here with the volatility risk premium, and we're above the band. That could be increasing some of the options prices that we're seeing. All right, then we're looking good here with the advanced decline line based on price and volume. We're setting another new all-time high based on volume. We have not surpassed these previous highs yet based on price. And that could be positive as well when we see volume leading price. We're back above zero with the advanced decline oscillator. We had dropped slightly below zero even on the update on Wednesday. Now we're back above it. And we're above zero with the short and intermediate term advanced decline ratio. We're really improving. We're seeing a gradual increase of the new highs here and not much of an expansion of the new lows. So that's turning our 5-day chart. It's not quite turning back up yet. The 10-day chart is trying to go back up as well. So we're seeing some more internal improvements. We're positive with our 3 smart money indicators now. We were getting a mixed picture after Wednesday. We're above the moving average here. That's the more conservative approach. And then we use the boom indicator, which is more short term. It's trying to measure the interaction between the indicator and the moving average itself. Doesn't do a great job, but we can still find some use from this. We're above the moving average with the boom indicator. And now we're going back up slightly here with the chicken money flow, where it was actually declining after Wednesday. We are still going up. We never did really turn down with the chicken oscillator, but this is going up. So our 3 smart money indicators are now back to positive. We're positive with the vortex with the green line above the red line. And I wanted to just bring up some of the advanced decline line studies that we have here. The cumulative advanced decline line for the S&P based on price, not at an all-time high yet, but we are when you look at the cumulative volume for the S&P. That's where we're seeing volume actually outperforming price right now, and that can be positive when volume leads price. All right, we're looking good with all our advanced decline line studies here. All the indexes are above their moving averages. And then we switch over to the NYSE, the cumulative advanced decline line, breaking out, setting a high here with the regular NYSE advanced decline line. And then we break it out based on common stock, setting a new high here based on volume. Not quite there yet based on price. And then here's another NYSE advanced decline line, which is setting a new all-time high. So that's showing some real improvement there. Then this is an apples to oranges comparison. We have the S&P 500 and then the NYSE. We're seeing some improvement there as both have been going up. Then longer term, the internal look across the broad market, a 5-period moving average of the highs and lows, still above 0 and going up. That's showing more internal strength. Then we look at those stocks inside the S&P above their 20-period moving average, above 50 and advancing. It's been really choppy lately. But this, on one hand, you can say, well, how come it's not really going up? All right, maybe it's just a few stocks that are really driving the S&P up. But on the other hand, it still means that we have more room to run to the upside with this indicator if we continue to go up before we start to look really extreme. Also improving here with the 50-period moving average study, the 100 and the 200. All of them are above 50, and so that's more positive. Then here, I put in this dashed line. This is the previous all-time high, and they're so close, and this is a longer-term chart that it looks like, okay, here we are. We're about, on an intraday basis, less than a point away. So we'll be seeing if we're able to actually go above it on an intraday basis. The interesting thing is going to be, can we close at a new all-time high if we have an up day on Friday? And improving and above 50 with the 20, 50, and 200 period moving averages on the S&P. This is now on the extreme list, which, again, when we're in a more positive backdrop, we don't necessarily look at this as overbought. We just show it as good momentum. This is the Stochk RSI. The Williams percent R, which has been on here for a few days, the CCI 14 and the CCI 20. And then we're looking positive with the short-term stochastic. And all 3 of these charts are further subdivisions of the short-term time frame. That's why I say it that way. We are positive, but above the green line in the intermediate short term, and we're crossing back above the moving average here with the long-term stochastic. So all 3 of these charts are back to looking positive. But with all 3 of these also, we're above their green lines, which means we are extreme positive as well. And the force index above the midpoint and going up, that's positive. And after seeing a little bit of vulnerability with the short-term trend, we were starting to come down with the lines here. Now we're looking a little bit better. And both the double and triple exponential moving averages are now going back up. And the standard deviations chart, we're up into the +3 channel. Again, we can stay there if we're seeing good, solid momentum, but we just want to be aware of this as well. The balance of power saw a nice little move up here above 0. That's positive. We're above the short-term trend here with the 10-day simple moving average, and all the lines are going up. That's positive. We're right on the verge here. We're just a little bit above this black line. And I put the black line on here, so there's no magic about that. I just use it as a visual reference point. But we're starting to look extreme with the CMB composite, but we still could go higher than where we're at. And we're positive with the go, no go with the darker blue bars. We're seeing the highest high value, which is the blue line. It's going up as price has been going up. That's positive. We're positive with another trending mechanism called the Landry Light, as well as the proper order. That continues to be positive. And for the second day now, we were seeing a little bit of weakness with the TTM squeeze where it was turning darker blue and declining. Now we've seen a couple of days where it's lighter blue and starting to go back up. So that's positive. And here's the rate of change going back 50 periods, still giving us an extreme reading off of those lows. Turning up just a little bit, but barely above zero here with the ease of movement. Above zero again, we switch back positive with the McClellan oscillator, not only for the S&P, but also the NYSE. So we're back positive here. So we're back to going up based on price, and we continue to go up based on volume. Now, after Wednesday, we were seeing a mix. We were below zero with the McClellan oscillator, so this chart should have been going down a little bit, but volume was still continuing to go up. So you could treat that more as positive when volume was holding up better than price. And here's the NYSE McClellan oscillator, back above zero. So now we're back to going up with the summation index based on, and there's really hard to see here because they've been pretty choppy lately. We're also going up slightly here based on volume. The Arun is above zero with the oscillator. This means that there's more buyers than sellers. The green line tries to measure the buyers. The red line is the sellers. And we're seeing the green line pegged at the top and the red line coming down. So the oscillator is looking more positive. We're above zero and advancing with the swing and trading oscillator based on price and volume. We're improving here with the PMO. We're not quite back across the moving average, but we're above this red line, which is extreme. Improving, but not really above the moving average yet based on price, where we are going back above the moving average based on volume. So we're slightly above 50 with the PMOs that are rising. We're improving, but still below 50 with the buy signals, and just kind of flat after declining with the PMOs above zero. Positive with the Elder's Impulse system for the S&P. Positive with the dots underneath with the parabolic SAR. Trying to turn back up at this green line, which is considered an extreme reading with the slope oscillator. Not quite back above the moving average yet with the MACD, but it is improving. So the short term, we're trying to turn back up here with the slope and TSI, improving, but not quite back above their moving averages with the three intermediate term oscillators, still declining with the TRIX and KST, which are longer term momentum oscillators, and still negative, kind of flatlining right now with the Copic curve momentum oscillator. Looking initially extreme here with the Sean trend meter. It's really extreme if we go up into this dark green area. So for right now, it's taken as positive. Above 50 with the money flow and the ultimate oscillator on balance volume is positive. Extreme with the percent B because we closed again outside of the, we did on Tuesday, not on Wednesday, but then again on Thursday, above the upper Bollinger Band. And you can see here, the Bollinger Bands were getting kind of close to each other as well. And so that's why when we did break out, we hit the upper Bollinger Band fairly quickly. Now, if we had had a decline because of the geopolitical things going on, we would have hit the lower Bollinger Band pretty quickly as well, likely. All right, and we're positive with the intermediate term RSI, but we're starting to go above the extreme reading here with the short term RSI based on 19 periods. Intermediate term trend, which was holding up better. We saw some vulnerability happening here. We came back down to the double exponential moving average based on 50 periods. Now we're going back up. The red line and the blue line are back to advancing. That's positive. Above all the plotted moving averages here, that's positive. But we're far away from the short-term moving average based on 20 periods and the intermediate term trend based on 50 periods. That's what the boom indicator tries to measure. And we're still positive with the bullish percent index. Not a huge move up, but it is positive. Ticking back up slightly with the NYSE bullish percent index and right at 70. It was flat. Even though you've got the NASDAQ 100 setting all-time highs, the bullish percent index didn't register any new buy signals with the bullish percent here. Okay. And here, we're up 2.9% so far on the week. So unless we have a 2.9% decline on Friday, we're going to have an up week here. And this is longer term, looking at these weekly bars, setting a series of higher highs and higher lows. That's looking much improved as well. We're positive across all of our different chart trend measurements here, charts. There, I think I said that right. The Heiken Ashi is positive. We're black and pointing up with the Kegi chart. The Renko chart is positive, and the three-line break is positive. Not enough yet to put in anything new into the point and figure chart, so that's why I'm not showing that here. Looking good with the 150 and 200 period moving averages. They're both above their midpoints here. And this should be changed because we're above the 200-day moving average here with the IWM that I'll show here in just a moment. So we'll see if somebody comes in and actually updates this. Bonds are positive in the short term based on price. Commodities are negative in the short term. The dollar is in a downtrend on all time frames. And we saw where staples in real estate, they were the down sectors, but energy bounced back up here. But then you had communication, discretionary, and tech. Not great big moves, but positive nonetheless, which is helping the overall landscape of the market. All green or blue here. Tech sector had a BPI 50. This is a golden cross when the 50 goes above the 200. We're waiting to see that happen with the S&P. It did happen with the NASDAQ 100 a couple of days ago. And then the Dow got above 43,000, and then the S&P is above it. We opened above 6,100. The NASDAQ got up to 20,000 and then 21. That's interesting. And then we have a 4-year high with the industrial sector. Industrials seeing a BPI cross above 80, and then Canada sets another new all-time high. Oil going back up. It was a little bit later in the day, and it's back up into the mid-60s. A lot of green here. Apple was down slightly, but you had some of the big boys up here. This is why tech lagged a little bit. Then you had Amazon up, Tesla down, but not very much. And then communication, Google, Meta, the two big players with Netflix setting another new all-time high here. All right, and we're seeing an improvement, but still a bit of a disconnect when we look at the weighted version of the S&P, which is the bar chart. The bigger stocks have more of an impact on how that's calculated, where the equal weight treats all the stocks the same. We're going up, and that's positive, but it would mean more broad market participation if the red line was closer to the bar chart, even though they're on different scales. Not much of a change here with the overall ratio. We've been going up, meaning that the weighted version is outperforming the equal weighted version, but it was up just slightly on Thursday. So that's encouraging in that we're seeing more broad participation within the S&P, not just a few stocks. The few stocks, the big boys, they're doing good, but now we're seeing a little bit more participation, which is helping our charts look a little better. And we're looking better here when we check out the Dow, which is having a really difficult time getting above its 200-day moving average. Now it's comfortably above it. We're positive with the Elder's Impulse system for the diamonds, looking pretty good here with the NASDAQ, and that could be an all-time high. We're at least close there. It's hard to see because of this S2, but we're not quite at a golden cross with the NASDAQ. Positive with the Elder's Impulse system for the NASDAQ. Here we are seeing a recent golden cross with the NASDAQ 100. These are the big stocks that make up the NASDAQ. So this is when that's leading, the market tends to do better, and it is leading. Positive with the Qs when looking at the Elder's Impulse system. Not quite positive yet with the momentum for the NASDAQ 100. The PPO still has yet to cross more comfortably above the moving average. This is also another concern that I've been bringing up recently. I talk about this in the weekly video, but I wanted to bring it up now. This is a weekly chart of the NASDAQ 100 with a trend line going back to 2009. And we're right at that trend line now. Now, a caveat is I put this trend line on here. And so it's like, okay, I try to match this up and then just extend it forward. This may be nothing, it may be something, but we just want to be aware of this anyway, that this could act as overhead resistance. Small caps, still below their 200-day moving average, still back to prices that we've seen before when we look at the S&P 600. But look at this with the other small cap index that we look at. We closed above the 200-day moving average. Can we hold on to that? Is this a breakout or will it be a fake out? That's what we're going to be watching for here. So this is improving. That's why I say that the green red arrows, it should be green now in the long term because the small caps, the Russell 2000 is now above their 200-day moving average. We are improving with momentum. That's measuring with a MACD, and we are above 50 and going up with the RSI. Positive after being neutral with the small caps with the Elder's Impulse system, above the 200-day moving average with the mid caps. Okay, should have changed that on the previous chart there. And the mid caps are also positive with the Elders Impulse system, looking better broad market wise, not at an all time high yet with the Wilshire 5000, also improving, but not quite back to an all time high with the total US stock ETF. Broad market measures, that's why I show these charts. Financial sector looking pretty good, coming down a little bit with the ratio, but what was causing the concern is when the financials were underperforming the S&P, came down to the 200-day moving average, and so far have been bouncing back up, even though the last couple of days they've been pulling back a bit. FANG index, all-time high. These are the mega caps, really big stocks here. Apple ended up being down, still dealing with a downtrend, and it's below its 50-day moving average. Amazon was up 2.42% above both moving averages. Microsoft, new all-time high, uptrend. Google, trying to get back above its 200-day moving average. Meta was up 2.46%, recent golden cross here. Nvidia, just on the verge of setting a golden cross. It was up 0.5%. It's probably going to happen unless we see almost a 30-point decline in Nvidia in Friday's session. And Tesla just kind of floundering around right now, but still above both moving averages. Netflix, another new all-time high. Then the semiconductors, which are a huge part of growth. We're starting to see a golden cross with the Dow Jones Semiconductor Index. We're not quite there yet with the SMH ETF. That's the semiconductor ETF here, but we're still looking good. We're just not quite back to a golden cross. We're above the rainbow with the SMH ETF. The ratio between semiconductors and the Dow continues to go up. We're getting closer to this blue line. That's positive. And we're continuing to go up. We didn't see much of a change here. When this is going up, that means the semis are outperforming tech. We want them both to do well, but when we're more positive is when this ratio is going up. And we're still going down when we look at the staples to tech ratio. That is positive. And kind of not really seeing much of a change here with the US to world short-term correlation. Still kind of drifting a little bit higher with the longer-term correlation. Oil is back up into the mid-60s. The dollar continues to go down. And we're coming down just a little bit in the latest reading from Truflation. They're at 2.22% here, where the last CPI came in at 2.4%. I don't have the red line on here this time because we're dropping down with the 10-year yield, which is helping stocks go up, and we're going up with the 10-year based on price. We are inverted, though. Yoo-hoo. The 10-year to 3-month yield curve has gone back to being inverted again. We're down into this red area. Just want to keep an eye on that. That could be a potential recessionary signal off into the future. And not so much with discretionary to the S&P, but the other growth to value ratios are improving. The Qs to S&P and large cap growth is outperforming large cap value. So the large caps are back above the moving average. The mid caps are going up. The small caps declined a little bit, but they're still above their moving average. This is another ratio. When it goes down, that's positive. Staples are underperforming the S&P. Staples are more defensive. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. All right, the outlook then. We are positive. Did I not change this? I have to move this little bar. We are trending now. I changed it on the conclusion side, but I didn't change it here. So sorry about that. We're going to get personal income and spending and core PCI. That's big. And that's the other big inflation report of the month. So that could be a real market mover in Friday's session. Consumer sentiment is played a bit more of a role since things are so emotional right now. We'll see how that impacts the market as well. Then anything geopolitical, there might be some hedging ahead of the weekend in case something geopolitical breaks, either positive or negative. So just be aware of that because Monday is going to be the last trading day of the month and quarter. All right, and then here is the finishing up of the economic calendar for the week with the previous readings and what they're expecting it to be at 0.1% here. Seasonality, no real edge, slightly positive for June 27th, going back to 2002. Neutral to positive for all three indexes. Oh, and we have options expiration, which tends to be down more than up. Unless we have a pretty big decline on Friday, we're probably going to have an up week. And then we have Friday's session and then Monday's session. That'll finish out June. We follow the green dashed line here, which holds up pretty well. This is the S&P during post-election years. And a little bit of a bounce up here according to the Carson chart going into the end of June. And then we do see a little bit of a move down here when we saw some weakness earlier in June, which seems to be repairing itself now before we have a little bit of an upward seasonal thrust going into July. This is a newer chart here looking out into July. I just wanted to show this a little bit early. Going back to 1950, that's the kind of brown thing here, positive. Past 20 years, that's blue, that's positive. Past 10 years, even more positive, and then post-election years, positive. So no matter how you dice up the historical data, July ends up being a positive month. Okay, and then we do see oftentimes a nice little upthrust in going into July, especially for the NASDAQ, which could also mean the NASDAQ 100. All right, we're still negative from a trending perspective with the discretionary to staples. We're improving with our momentum oscillators, but we haven't quite switched all the way over to positive yet. And the long-term special K chart, which I'll go over in the weekend video, the deep dive video, that's still negative. And we're almost looking positive again with the momentum for the NASDAQ 100. Smart money indicators are positive. The trend growth of value for the S&P is positive. The NYSE and S&P McClellan oscillators and summation indexes are back over on the positive side, where after Wednesday they were on the negative side. Parabolic SAR continues to be positive. The bullish percent indexes across all the three indexes that we follow are positive. Swelling trading oscillator is positive. Ease of movement, money flow, and ultimate oscillator are positive. The vortex is positive, and the financial sector is positive. And here are the pivot points for Friday's session, which I update every day on the YouTube community tab. All right, conclusion. This is where I did change it. We're positive, and now we're starting to develop a trend. In both the short term with the short-term ADX chart, we're above the moving average. Not confirmed, but we are starting a trend. And we're also seeing an unconfirmed trend in the intermediate term. We continue to be positive with the long term because we're above the 200-day moving average. But we haven't seen a golden cross yet. But the longer we stay above both of those moving averages, that will eventually happen. So thank you. Have a really good day on Friday, and I will talk to you in the next video.